Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby. Today, I'm joined by Eben Burr, president of Taves Asset Management and the Behavioral Investing Institute. He's here to discuss the results of a new study commissioned by the Institute to look at clients' behavioral traits and their readiness for the next big drawdown. Welcome to the show, sir.
Thank you very much. And I am extraordinarily pleased to be here. And I think that I have maybe listened to all, if not almost all, of your podcasts. So I'm interested.
A Standard Deviation super fan who now has made it to the show. Welcome, sir. And our listeners won't be able to see, but you are wearing the coolest polo shirt I have ever seen in my life. So just imagine the coolest polo you can, and then it's 10 times better than that. So
my wife to thank for that.
She has wonderful taste. So, Eben, Taves recently commissioned a fairly exhaustive look at many aspects of behavioral investing, everything from client expectations to gender and wealth differences and risk attitudes, our readiness for the next big crash. What was the impetus behind all of this? What made you want to do this research in the first place?
Well, it's actually a follow-up study to one we did last year. And we've been going on many assumptions for the portfolio advice that we give, as well as the behavioral advice that we give for many, many years. So to sort of back up a little bit, about 10 years ago, right after the financial crisis, we saw a lot of people doing the wrong thing at the wrong time with their money. This is no secret to anyone in the industry. It's normal sort of behavior that we expect, right? You run away from a decline, you run into the crest of a wave, as it were. So we had this set of assumptions that people don't know how bad it can get. You know, they don't know market history, especially anything that happened before they started investing. So on that subject, when we think about significant events in our lives, like when I think about the financial crisis, I can remember people in our office screaming obscenities into the phone. I remember one in particular about, I'm going to throw you in front of a bus, right? When these stresses were high, let's just say. While I remember those events, I can't conjure the feelings of fear that I had from that period. Mm-hmm. And I think that, and I'm sure that you maybe the length of time one can sort of hold on to the feeling versus the memory. Barring significant trauma, I would imagine is different. Mm. But for those significant challenges that happened before our memories, let alone the ones that happened recently that maybe we can still feel, but those that happened before our memories even served us, they're just stories, right? There's a story of inflation in the 70s. I kind of remember waiting in line with my dad to buy gas. And I remember candy bars going from 25 cents to 35 cents, which was pretty significant as a kid. But those are most of it is just stories. What happened after World War II, the Great Depression, all these things are just kind of stories in my mind. And most people who don't work in an industry have even vaguer, is it vaguer even a word? Knowledge of what those stories are. So people don't know how bad it can get, was one of our assumptions. And what would they do if one of those worst case scenarios played out? What would their response be? And it would be an imagined response, right? If we're asking someone, what is your imagined response to a situation, which is always going to be different from what your actual response is going to be because you don't know the circumstances around it, mm-hmm. which is one of those things that makes risk tolerance questionnaires, the standard ones anyway, really iffy. What are you going to do if the market goes down 15% is a classic question, or 20%. And the answer, of course, is, I don't know. Did it go down 20% in one day? Did it go down 20% because there was a dirty bomb in New York? I don't know. And then are people willing to accept lower returns for a lower probability of participating in significant declines? And what we found is all but 10% of investors said, yes, absolutely.
Mm-hmm.
And then the impact of knowing that there is crisis management in place in a portfolio. What does that do for you? And overwhelmingly, it brings peace of mind. So we had these assumptions that we wanted to verify. And we ran the study last year just asking advisors questions about what they thought and what, about their clients. And then this year we updated it to asking clients and advisors the same questions. So we asked the advisors what they thought about, whether we're in a bubble, let's say. Then we asked the advisors what they think their clients think. And then we asked the investors what they think. So there's sort of three perspectives there, two of them from one party. And the whole thing was really, really interesting. And we came away with a clearer view that there is massive disconnect in communication and understanding between clients and between investors and the advisors, which, we sort of knew anecdotally, and one can make that assumption, but actually having hard data about the specifics of it is really fascinating. And being able to see how it differs by age and by gender and by wealth, and actually even timing. So the study that we did last year was at the beginning of the decline. So about half the answers came in before the market really started to decline and half came in after. And the answers are different.
Yeah.
Right. So it totally blows up the idea that a risk tolerance questionnaire has any long lasting significance, because this is a matter of 2 weeks and the answers were different. So we know that as fear takes hold, you respond differently. And of course, we knew that as normal thinking human beings, but then to have the data to show it is really significant. And so then the question is, okay, how do we solve this? How do we solve for all of these differences in attitude and understanding and communication and interpretation and internalization of information? So that's what we're working on.
No, fascinating stuff. Couple of comments. First of all, whenever we talk about sort of people's responses in a hot versus cool emotional state, I always go back to the Ariely research where they were trying to get to the bottom of how STIs spread, right? They're trying to get at people's sexual behavior, which is, tricky, right? Tricky to measure. People are sort of reluctant to accurately self-report on this. So Ariely and company asked them all these questions about, appropriate sexual behavior, like, would you cheat on your partner? Do you use protection? These sorts of things. And everyone gives the right answer, right? In a cool emotional state, everyone gives the right answer. Well, then, this is a family program, but they show them pictures that make them have amorous feelings. And then they give them the same questionnaire again, and everything's out the window, right? Like everyone's answers have changed dramatically. It's one of the reasons why we are such big proponents of measuring risk composure, which is, effectively the emotional lability of someone's scores, how much they're going to fluctuate. Because for some people, they're relatively stoic. Other people are all over the map, depending on, what happened last week. So you're right. These are fascinating results. I want to get into some of these fascinating results. So the first thing that jumped out at me, it's like 70 something pages, but I looked at every one. It was lots of great stuff. You found that clients are 3 times more likely than their advisors to say that they are very knowledgeable. So again, you ask, advisors, what are your clients like? And you ask the clients, what are you like? And you sort of compare the delta. So clients are 3 times as likely to say that they're very knowledgeable about markets as their advisors are to say that of them. And then men had a similarly outsized impact on saying that they were very knowledgeable. Men were 3 times as likely as women to say that they were very knowledgeable about markets. So I'm going to ask you to make some inferences here. Do you think that clients misunderstand themselves, or are advisors misunderstanding their clients?
Well, I would start that by saying we are all misunderstanding ourselves and each other all of the time, depending on what circumstances are presenting themselves at the moment, right? I mean, well, let me ask you a question. I know that's obnoxious. It's your show, but why were you interested in becoming a therapist?
Because I was a deeply flawed individual. I wanted to figure out my own quirks.
So you wanted to understand yourself a little better.
I wanted to understand myself better and people in my orbit. I had friends that I was helping through various crises, and I found that fulfilling and rewarding. And I also wanted to understand what made me tick, certainly.
Yeah. So it was about understanding, right? It was
Sure.
about understanding you and others and helping them. And so if we sort of take that as a little piece of our world, that understanding of oneself and others is very hard to begin with. And then you involve the heightened emotions around one's money and mortality, which are inextricably linked, right? Then we have a really difficult situation for the advisor understanding the investor even listening to what the advisor is saying, let alone bringing it into their brain and heart and making it part of what they're able to accomplish on a regular basis. Mm-hmm. So yes, clients misunderstand themselves, advisors misunderstand clients, we all misunderstand each other. And you were mentioning hot and cold emotional states. Well, if a discussion is two people presenting their thoughts, and a debate is two people trying to convince the others of their thoughts, and an argument is two people trying to convince each other of their thoughts while not listening to the other person, then it's sort of similar in heightened states of emotion, right? In the teeth of last year's late March, when you can't really understand what's going on, what a global pandemic means, what markets falling through the floor. Well, how can you really listen to what's going on and internalize what's happening? That needs to be set up far, far in advance and have a structure to fall back on, to recognize what's going on, what the appropriate response is, what the likely outcomes are in the long term. So yeah, misunderstanding is rampant and between client and advisor, and we have a lot of information about that. When you think of advisors and clients, over 50% of advisors believe that we are not in a bubble market. Over 50% of investors believe we are in a bubble. So even there's some miscommunication, right? It's the advisor's job to be the voice of wisdom for this client, and like the ever knowledgeable Brian Portnoy talks about the information diet, right? They're the ones that are supposed to be the dietitian of that information. Yet, it's a very difficult thing to do.
Yeah. So, question here. I totally agree with you that misunderstanding is rampant. That it goes in both directions. I'm also familiar with some research that I thought was fascinating that I talk about all the time, where there's research to suggest that your coworkers are better predictors of your behavior than you are, right? So we see ourselves through sort of a optimistic, compassionate, self-serving lens, and others in some ways see us, more dispassionately and are better equipped to predict how we're going to behave. And I think that dynamic is at play in the advisor-client dynamic. So while we're agreed upon the fact that misunderstanding is rampant, what can we do as an advisory community, as a financial services profession, to minimize the delta between who people are and how we see them? Are there things that we can do better as an industry to better understand our clients?
There are, and there are a lot of great tools that are coming out now that I think you're even involved with some of them. We certainly are at the Behavioral Investing Institute. Accelerate the idea of accelerated learning, right? How can we learn who our clients are on a deeper level faster to help them to make better decisions over the long run, right? So can we get them to show us who they are, not just tell us? Right? We were talking about how we present ourselves differently in different situations, and some people, when answering questions, they may present themselves aspirationally, right? Like, this is who I wish that I were, so this is who I'm going to say that I am, because maybe if I keep saying it, I'll become that person,
Sure.
right? Then there are others that are sort of, the sort of minority, I think, are sort of grounded in, this is who I am, and this is probably what I would do. And then there are others that are defeatists about it.
Yeah.
I'm always going to get it wrong. The money thing is too confusing. It's scary. So I think that while education has been proven to do not a ton in the long run, it's because of the way that education is presented. Mm-hmm. And when I think of education, I think of it as a didactic communication of knowledge, right? Here, I'm going to give you this information. Whereas training is the application of information. And so I think that trying to put out a fire or talk someone off the cliff with education is not going to work in most cases.
Yes.
Whereas if you've built a structure of training where they have an understanding of how bad it can get, what the history is, how they're likely to respond, and another way of looking at it, that can sort of build a scaffolding over the gulfs of challenges that they may experience. I think we all have a breaking point with everything, right? That's why torture works. Not that I'm advocating torture. I'm just saying that it has, and I'll leave that in fact. We all have a breaking point, whether it is a significant decline, a flat market, inflation, whatever it might be, there's some point where we say enough, I can't take it anymore. And so the advisory community, part of their job is to help extend that breaking point and to do that through training. And in some ways, it's one of the ways is to vaccinate people in essence against these things, right? Give them little doses of it on a regular basis to understand, okay, we're going to have significant declines. We're going to have inflation. We're going to have bubbles. We're going to have rising interest rates. All these things are going to likely to occur during your investing lifetime. So let's talk about them specifically and how you might respond to them. And then let's talk about pre-commitments. What are we going to do when they do happen? And we both have an obligation there. The advisor has an obligation and the investor has an obligation. And I would think most investors think, well, my obligation is to pay you 1%. That's my obligation. So get with it, pal.
Yeah.
But really, I think most smart people and accomplished people, and the people that we questioned in this study had, the bulk of them had investable assets between $1 and $5 million. So they're not, they've had some success in life.
Yeah.
Those people are generally, they welcome a challenge. Mm-hmm. So, okay, this is what we're going to do when this happens. Here's what you're going to do, and here's what I'm going to do. And we're going to do this together. So not just telling them the plan, but including them in the plan, which doesn't mean letting them have asset allocation, decision-making abilities, right? They don't get to choose that you're going to buy a bajillion shares of Tesla because it's awesome, right? No, but you want them to have buy-in on the entire process so that they feel ownership of the process and the plan.
Yeah, I love this idea of sort of self-education and just helping clients be a bit of a market historian as a form of inoculation. I think most people, when you look at the fact that over the last 35 years, we've had an average intra-year drawdown of about 14%, I think that would surprise most people, because every time there's a 10% dip in the market, the talking heads talk about it like it's the first time that it's ever happened, not like it's, as regular as your birthday. Right. And so I think that if we can help people get a sense of perspective and expectation, I think we can inoculate them against some of the worst behavior. Let's talk, just finishing off this question, let's talk a little bit about the confidence finding with respect to men. I mean, I think it certainly conforms to the popular characterization of men as being more confident and perhaps more overconfident than women. Is that what you take from this, or do you have a different take?
The men confidence question is kind of an ugh to me. It's sort of, it just reeks of like the no remorse bumper sticker.
Yeah, right.
We know from countless other studies that women are better at this.
Yeah.
Women are better, more patient investors. Yet when hiring people, almost all of the applicants are men.
Mm-hmm.
And so women listening to this podcast, please, well, I guess if you're listening to, you're already in the industry, tell your fellow women that are not in the industry, it's a great, interesting place to work and you're naturally better at it. So please come, it's fun. I think one of the things about the male overconfidence in this industry, let's just keep it to this industry, is that it wasn't until 1974 and the Equal Credit Opportunity Act that women, and if you're not familiar with that, it made discrimination based on race, sex, familial status, I think, and a few other things illegal. So before that, if a woman wanted to apply for a credit card or some of the other groups mentioned, they could be denied. Just, they get out the rubber stamp and stamp woman on it. Mm-hmm. And that was a reasonable reason to deny them credit. Mm-hmm. Now, so we're only a couple generations of women in this industry away from that. Not that there weren't women in the industry before, but it has been such a male-dominated industry and still is, unfortunately, that I think men's experience in this industry as their industry is that they know. So, that comparison of they know compared to who, right? With the investors saying, as you mentioned before, thinking that they were very knowledgeable, 3 times more likely than the advisors say they're very knowledgeable. It's a matter of who they're comparing themselves to. Are they comparing themselves to their family members, in which case maybe they are? Mm-hmm. Where the advisor is comparing them to themselves, right. In which case they're likely not as knowledgeable because they're not in the industry. So the men thing is tough, and I wish that we had more women in the industry to show them how it's done.
Yeah, it's always amazing. And the other thing that I look at, when you look at the financial confidence gap, I've looked at that by age cohort and by gender. And what you find is that among folks who are 65 and older, the financial confidence gap between men and women is enormous. And, between people in middle age, it shrinks somewhat, but is still very present. Among young adults, it's almost shrinks to zero. And what will be interesting to see is, I just sort of think everything's good and bad. On the one hand, we're socializing and raising a generation of young women and girls to be part of the conversation, to hopefully get into the industry in bigger and better ways. Hopefully, we're promoting egalitarian attitudes about money. And it'll be interesting to see that as society reaches greater parity with respect to men and women and how they think about money and the degree to which they're part of the financial industry. Maybe we can dream of a day when women are just as bad with money as men are. But
we can only dream, Daniel.
But today, as it stands right now, women are quite a bit better. All the research is with you. So one of the findings that I found fascinating, we think, the birthday song goes, another year older and wiser too. And yet in your study, you found that self-reported investment knowledge falls with age. Okay, so the older someone was, the less they reported having, a discernible level of investment knowledge. So what do you think is at play here behind the scenes? Is age sort of engendering greater humility? Are markets humbling people who have, seen some things? Or is this generation just maybe more plugged in and like legitimately more knowledgeable than their parents and grandparents?
So I would say it's a little, actually, I was going to say it's a little bit of both. It's a lot of both. Mm-hmm. And my father-in-law has a lot of great aphorisms. And one of them is, and maybe he got it from somewhere else, but the most you'll ever know about parenting is the day before your first child is born.
Right.
And so maybe it's the same thing with investing. The most you'll know about investing is the day before your first bear market.
Sure.
So 50% of people under 45 believe that they are very knowledgeable about investing in the markets. I have a friend who works for the Attorney General in New York in the sort of tech department, and he always has a troop of 25 recent college graduates working on computery stuff. And right now, 100% of those 25 students are trading in the markets. 100%, all of them.
Wow.
That was not the case before you could just switch from, you could pick up your exocortex. Well, I guess your exocortex was already in your hand, and you could switch from Instagram to Robinhood and buy some stocks and then go back to, flipping through your friends.
Yeah.
So absolutely, it is a much more plugged in world now where expectations are that it is going to be extraordinarily easy to trade, just as easy as everything else is on your phone, and that you're going to win because that's all we've done for the last 12 years, right? It's been easy. So if let's say you've had a job for 11, 12 years, whatever that job might be, maybe you're an attorney, you've got some experience, right? You know what you're doing at that point. Well, in this industry, if you've been doing this for 11 or 12 years, you've had rising markets, a couple flat markets, and a little dip, right?
Yeah.
But basically, there has been very little trauma. Last year was scary, but by the time investors got their statements, the market had already bounced back significantly. So if they were older investors who actually look at their statements rather than just picking up their phone, their exocortex, and checking there at every possible moment of the day, it wasn't as significant, right? So as you were saying, the older you get, the less knowledgeable people report themselves as. So they've been through markets that have humbled them. Yes. They also just have the wisdom of experience to know that this is complicated. You and I have talked about Bitcoin before, and how I've had, you and I both have had friends who are like, you got to do this, 10 years ago. This is the future. You got to do it. It just seemed too hard, right? And now the more I learn about it, the more I realize I just know nothing. The more I learn, the less I know. And it's amazing. And I think that is a function of age, as well as the young people just being more plugged in because it is easier.
Yeah, I'm going to be fascinated to see sort of the net of all this involvement in markets. On the one hand, I'm thrilled. Like I'm thrilled that people are, and especially young people, are learning about markets at a younger age. They're getting involved. They're starting to save. And then on the other hand, I see a lot of sort of, what you'd call poor behavior with respect. It's not all sensible. It's not all sensible investing. A lot of it's very risky. A lot of it's very ill-informed. And I think a lot of people are getting the right result for the wrong reason and sort of learning the wrong lesson. So
I think you just described my youth. Ill-informed, just all of that was, isn't that what being young is about, right?
Yeah.
Making the wrong decisions to find the right decisions, taking on risks that you then realize are unreasonable as you mature. It's just now it's happening on one's phone with options.
Yeah.
And so I think that it's both, fantastic and terrifying. When you're young, I used to do a lot of martial arts. And at one point I had to stop because it went from getting hurt to getting injured. I didn't mind the getting hurt. I was doing martial arts. That's what you expect. But after a couple surgeries and a blown out eardrum, I was like, okay, these are injuries.
Yeah.
These are no longer getting hurt. And so I think for the most part, younger people have less money and they will sustain injuries, or they'll get hurt, but hopefully sustain fewer injuries. And as they mature, they will realize that perhaps a plan might be a decent idea.
That's a great parallel. That's my hope, is that people learn the right lessons, right? They learn the right lessons from this, whether they come out on top or not, that they learn the right lesson, and that it's a gateway to, a lifetime of sensible engagement with capital markets, and not that folks get burned so badly, injured, to use your term, so badly that they can't bounce back. So let's talk about these expectations, though. So, Meb Faber and others are always posting things on Twitter and LinkedIn about forward return expectations that investors have. And he's posted some stuff that's like in the ballpark of 17% annualized. And this is very consistent with people's sort of the psychological tendency for people to anchor to the present and sort of project it into the future indefinitely. Because we've been getting 15 or 20% a year for some time now. So in some ways, it's not surprising. In your study, you found that most folks, so 59% of people, are expecting a 5 to 9% increase annualized over the next 5 years, an expectation that falls with age. So younger folks are expecting higher returns than older people. So normally, I would say totally reasonable. 5 to 9% is right in line with long-term historical averages. However, on the back of 12 years of plenty, like you've just talked about, I sort of feel like that feels like a stretch, perhaps. But to be candid, I thought it was a stretch 5 years ago too. I mean, and I was wrong. So how do you think about this? What are you seeing in terms of people's forward return expectations? And do advisors have work to do to kind of temper those expectations?
Oh, yeah. There's So, I don't know about, I looked at some of the results of that study as well, and I don't know who the people were that were polled. So the people that were polled here, as I mentioned, are those working with an advisor and have the bulk of them between $1 million and $5 million investable. Mm-hmm. So that group that was polled, that came up with 18% number, may be a broader swath that aren't working with an advisor.
Right.
What we found are a little less than a quarter of clients, investors, are expecting 11% or more per year.
Yeah.
And about a sixth, under 45, are expecting 20% annualized over the next 5 years. Annualized over the next 5 years, they're expecting 20+%. There are 0% people over 75 who are expecting that, right? Because they've been around a little while. So 45 in our world is considered young, which is kind of funny. But it's the way it is, right? So let's give those people the benefit of the doubt and say they started investing when they were 25.
Yeah.
Right. Which 20 years ago was not as easy as it is now, right? You had to go through some hoops for sure. Mm-hmm. What they've experienced for half of their investing life is, what we're just talking about, super bull markets. The 5-year number on the S&P, the 5-year annualized number on the S&P is 18%. The 10-year is 15%. So when we talk about the education and training, they've been trained that that's what they're going to get.
Yeah.
So it's not unreasonable that they would expect higher returns based on that training. It is unreasonable when you look at long-term history of markets. That's just not the norm. And if one wants to get a consistent return, I'm sure you can go to your local bank and get a CD with a 0.000005 return, right? But what you were saying about expectations from our study being somewhat reasonable in the bulk of them, in that 5 to 9%, feeling unreasonable now. I don't think it takes into account that returns aren't consistent, and that to average out the last 20 years or 10 years of whatever returns into that long-term average of about 10% for the S&P, we're going to see some pain at some point. Now, I would love as an industry to get away from the projecting of what's going to happen next.
Right.
guessing what's going to, and we keep track every year of what top Wall Street strategists predict the S&P to do that year. They are wildly wrong always. So we have back to 2000, what they predict every year will be. They got it right once by accident, I think 2005, this sort of consensus. Other than that, they always predict positive. The average of their predictions, surprise, surprise, is about 10%. And they are off by, I think it's 13 percentage points, plus or minus. So that is a very, very wide spread of wrongness, right?
What's incredible to me is I looked at all the big end of year S&P forecasts, right? Because I mean, all the Corona stuff started happening. Well, it sort of came to the public consciousness in February and early to mid March. So you look at the banks and what they were saying in January for the year and their expectations for the year. What's incredible is that last year, every single major shop on Wall Street undershot the actual performance of the S&P dramatically. And if you had told them in January, hey, there will be a global shutdown and a worldwide pandemic, they would have missed it by that much more, right? I mean, they would have lowered their forecasts, I think, enormously. And so forecasting really is a loser's game. But, I try to think in terms of probabilities and not sort of binary forecasts. And from a probabilistic perspective, I think you could say two things with a fair degree of certainty. Over the medium term, 5 to 10 years, I think it's unlikely that you get 9% a year if past is prologue. And I think we could say with a high degree of probability that there will be a great deal of pain somewhere in those 9 years, because there just kind of always is. So we have to help clients expect, clients hear, oh, markets do about 10% a year. And they go, oh, okay, cool. And they get out the compound interest calculator and they go, oh, okay, that's a good gig. 10% more every year than the year before. We need to help them understand that they do about 10% a year, but that it's almost never 10%. It's going to be up 40, down 20, and so forth.
Yeah, when you look at if you round the S&P to whole numbers, since the mid 40s, it's hit 10% twice. So let's instead of trying to guess, let's create plans that accommodate for the different kinds of markets that we're going to experience. And I like to think of it, I like riding bicycles. And so I think of it as the spokes on the wheel, right? The spokes can't all be on one side or it's not going to roll. And so you need spokes that will accommodate for the different kinds of markets that we're going to have. And, while the average that we see is there are 237% declines per decade, and that's going back to the beginning of the 20th century. Mm-hmm. So, these things are going to keep happening. All these different kinds of challenging markets are going to keep happening. New kinds of challenges are going to arise. So let's stop trying to guess and start trying to build logical plans that accommodate for the balance of behavioral and emotion, or behavioral and economic needs.
Yeah. Okay. So let's stay on the topic of plans for a moment. One of the things that a drum that I have been beating for a very long time is that a lot of advisors who say their clients have a plan, when you ask the clients if they have a plan, they don't know that they have one, right? So there is clearly sort of a large chasm between how we think we're communicating with our clients and how that communication is being picked up. That was something you all found in your study as well, that there's a huge gap between how well advisors think they've communicated their plan and how well that plan has actually been communicated. I think that is a big thing for the industry to pick up on. Like, we are perhaps doing the right thing in most instances, but not in a way that matters, or not in a way where there's uptake with our clients. Any more insights you have there, or any sort of practical tips you have for advisors to give a plan that actually sticks and resonates with a client?
Absolutely. So in the Behavioral Investing Institute, we coach investment advisors. So I spend a lot of time talking to investment advisors. And I love investment advisors because most of them are out there really trying to make a difference in people's lives and help people to achieve their objectives and live a comfortable life where they are satisfied. So when polled, 70% of advisors said that they had communicated a plan of what to do during a significant decline. Only 50% of investors say that their advisors communicated that plan. Of those 50% that say that they communicated the plan, what do you think the percentage is that actually know what that plan is?
Right.
So I wish we'd asked that question. It would have been a difficult question to ask, but I'm going to guess it's pretty low.
Mm-hmm.
So yeah, they told me, yeah, they did. But that follow-up question, what is the plan? Well, we're going to get more bonds or something. What we found was there was confusion basically about what to do in the case of, of this plan for significant declines. We asked the advisors what they would do, and 2/3 of them said in a significant decline, we're going to buy more stocks. That was not the case with the investors. Their answers were all over the place. Basically, what their answers said is, we don't know. And we also have, you can point to the studies, we can all look at them, that is an aspirational claim by the investment advisors that they are going to buy more stocks when the market goes down. We can see over and over and over again with the dot-com bust, with the financial crisis, with last year, that has not been the case. They either freeze or in some cases they sell. You can see the outflows, time after time. So I think that what practical tips do we have here? It is constant reinforcement of the plan, creating framework for market challenges. So as I was sort of saying, building a scaffolding, right? Building a structure so that they know what these challenges are going to be, and communicating them clearly when people are in that calm state of mind, right? This is what we're going to do. Here's how your portfolio is designed to accommodate for the challenge. Here's the history behind that challenge. Let's say it's significant declines, right? All right, here's how your portfolio is designed to deal with significant declines. Here's the history behind them. Generally, after significant decline, the markets bounce back up. Here is what instinctively you will likely want to do, which is run away from that thing which is trying to kill you. So let's think of another way of looking at that. Let's think of it as a sale, right? Let's try and ingrain that. Let's rewire ourselves, myelination in your brain. Let's rewire that to being a sale. Now, what is your response likely to be in that? What is your emotional and, reactive response going to be? You're likely going to want to do something rash, right? We as Americans are great at taking action. We're not great at introspection, but we are awesome at taking action. So we're going to want to take action when that happens. And then so the advisor would want to normalize and externalize that, right? It's normal to want to be afraid. It's normal to want to get out of the way of this thing that's trying to kill you. Normalizing it, externalizing it. A lot of people feel this way. I feel this way sometimes, but, and this is where it gets to the pre-commitment, what we're going to do. This is what we're going to do. I'm going to buy more. You're going to see this as an opportunity and hang tight. So building, and you can do that for any challenge, build a structure around it like that at calm times, and then reinforce the plan in different ways. Because, well, what kind of learner are you? Visual, oral, verbal, physical, social, which one you got?
Are you asking me?
I'm asking you.
So I will have to tell you then that the psych research on learning styles found that it's pretty lame, that there isn't much of a difference between the different types, and that I don't believe in learning styles.
Amazing. I'm so psyched to hear that. That's fantastic. So that's really, I love that. Thank you for that.
Yeah.
So, but what I would take from that is that one needs to communicate in lots of different ways though, right?
Sure. That's what they find, right? That's what they find, that you need to communicate in lots of different ways. And that sort of good teaching is good teaching, right? I mean, and good teaching is multimodal, right? Absolutely. It's didactic, it's experiential, it's got pieces of everything. But that good teaching looks a lot more like itself than sort of this highly individualized thing that we maybe sort of thought was the case in the past. Yeah, that's been pretty that's been pretty thoroughly dunked on at this point. So yeah, good multimodal good teaching is good teaching. And, I just want to, I want to build on something you said too, which, you use the word normalize. Back when I was a therapist, that was the first thing we were taught to do, right? And it's a little counterintuitive to say like, oh, like, client comes in and they're like, I'm in pain, I want to sell everything. It's a little counterintuitive for you to go, yeah, that makes sense. And I kind of feel the same way too. We instead go, oh no, how dare you? You can't do this. This is the time to double down, blood in the streets, whatever, sort of Wall Street maxims. But it's only after we sort of roll with that resistance that our clients will actually listen to us. It's only after we've normalized their response, instead of telling them that they're irrational or they're silly or they're short-sighted. You can normalize a behavior without condoning it, right? Like you can normalize a behavior and then follow that up by saying, I feel that way, you feel that way. Here's why we're not going to do that, right? Normalization isn't permission, and I think that sometimes we confuse those things.
Yeah, and with that, here's what we're going to do. This is what we are going to do instead. And another thing is, I think that because our industry, as most do, has such a specific language to it, that we lose track of being able to speak in intelligible sentences to normal people.
Right. Right.
So when we ask the question about asking investors, are we in a bubble? 15% of people over 75 did not know what that term meant.
Wow.
Right? We just think stock market bubble. Everybody knows what that is. That's just an everything, right? Everybody knows what that means. But 15%, and yeah, that's a small number of people over 75, but it's a number at all, right? So when we think about the most basic terminology, don't say equities, say stocks. Don't say fixed income, say bonds. I've heard people say you're dumbing it down. You're not dumbing it down. You're smartening it up because you're making it accessible to more people.
Well, and there's two things, there's two things with jargon. I think jargon serves a gatekeeping function, right? That's why we get paid the big bucks, and that's why any profession gets paid the big bucks, because they know the right words and they call it a contusion and not a bruise, or whatever, right? Jargon serves a gatekeeping function that allows people within a profession to charge a premium for what they do. So I think we over rely on it. I think a fish doesn't know it's wet, so we talk to each other about equities and fixed income and bubbles all the time, and just assume everyone knows what that's what it means. But I think sometimes we get insecure about the value that we add too. They go, well, I need to put on, I think especially for young advisors or young people, now I need to put on this sort of air of, this air of prestige or whatever to try and influence my clients and impress them and help them think that I'm adding value, when the opposite is actually the case, that people don't want to be talked down to, people don't want to be made to feel confused. And that if you can break it down for a client in a way that they can understand, to me, that 15% don't know what a bubble is one of the most powerful findings in your whole study, because it shows you the extent to which a term that is really a colloquial term. I mean, that's a term that is used fairly widely. That's not one that I would have assumed had a lot of misunderstanding around it, but it shows you just how prevalent it is. That's great. I mean, that speaks to the power of deep connection and getting rid of the jargon and just connecting with someone where they're at. So while we're on bubbles now that everyone on the podcast knows what a bubble is, I want to talk about this bubble thing. I'm really sort of two minds here, because what you found in the study is that twice as many investors, like in clients, as advisors, think that we are in a bubble right now. I'm curious what you make of that, and whether or not you think it's the role of a financial advisor to sort of be on the lookout for financial bubbles. Because, on the one hand, we know the wealth destroying impact of a bubble is tremendous. But on the other hand, we know that there's also sort of a bubble in calling market bubbles, and that this is something that people like to sort of scream about on the news, and have been for many years, and they've been wrong. So how do you think about that as an advisor's job, to be sort of a watch person for financial bubbles?
Well, I mean, if there were a Hippocratic oath for advisors, do no harm, right? Yeah. Preservation of wealth over growth, I think, is paramount. And it is shocking, this disconnect between what the investors and the advisors think about a bubble, though I can understand it on some level, because if we're assuming that advisors have more knowledge about markets, which we would hope that they do, right? They may see, okay, well, the Fed has supported risk assets, and has continued to do so in an extreme way. We're still sort of in the financial crisis market support mode. Then, well, we can see that the Fed is going to continue to support as much as it can, right? So maybe it doesn't feel like a bubble; it just feels like a supported market that we're continuing to participate in. And for an end user investor, they see that Jeff Bezos has more money than the GDP of 3/4 of the countries on the globe, and they think that's bananas. Yeah. How can that be? It must be a bubble, right? I can see it. I think it is absolutely the advisor's job to plan for the unexpected. And what we've seen over the last, from the dot-com bust to the financial crisis to the end of 2018 to last year, to all of these declines, they have picked up in speed exponentially. So for an advisor to think, well, I'll just make sure to get out before the next one.
Yeah.
Hogwash.
Yeah.
Right. It's not likely to happen. So one, as an advisor, needs to plan for these unexpected events. And whether we're in a bubble or not, in some ways doesn't matter, because nobody expected last year for what happened. I don't think, and I think an equal number of people didn't expect the massive rebound from last year. So neither of those things were expected. And we've seen over and over again that, as we were saying before, prediction is a fool's game. So yes, it is absolutely the role of the financial advisor to accommodate for the unexpected. And, markets can go from ridiculous to absurd to bananas. And, the bubble can keep getting bigger and bigger, even if we think it's totally unreasonable.
Yeah, and I think it's important, just with my own money, I've been trying to look for pockets of sanity, right? And I think there's plenty, candidly. I think there's, plenty of things that are reasonably priced. I think some of the bubble alarms have been sounded because it's kind of come to everyday items, right? We 3 houses in my neighborhood went on sale the other Friday, and they were all gone the same day, right? I mean, it's just like things like that. Like we see the price of lumber and toilet paper and all this stuff just going crazy. And so I think it's easy for the everyman or every woman to look around and go, hey, like there's some things in my surroundings that are feeling kind of bubbly. But I think it's an advisor's job to be on the lookout and to help them find parts of the market that maybe aren't quite so bubbly. So last question here. One of the things that I'm very interested in and am always trying to combat against is non-compliance with advice. So we know that across sort of context, everything from, medical advice to nutrition and, doing what your trainer says, to doing what your physician says, to doing what your advisor says. There's a huge body of literature to say that people do not follow through with advice. One of the leading causes of death in our country is people not taking their medication as prescribed. So people who are sick, have been to the doctor, have gotten a diagnosis, have gotten a treatment and a cure, and then they just don't take it, right? So I mean, people are stubborn. There's this last mile problem. There's this behavior gap that's well documented. Yet, In your survey, you found that 98% of advisors say that many or most of their clients follow their advice. What do you make of this disconnect between sort of the extant literature that says that people don't really listen to advice all that well, and the advisors that you're talking to that are saying, yeah, people do what I ask them to do?
Well, I think there's a couple things there. Some of these advisors and investors that we're talking to, they're going to have discretion, right? So there's not really a choice so much there. And I think that the advisors are seeing what the clients are following through on. But I think ultimately there's a broken advisor communication model, which is that I'm going to tell you some stuff, you're going to understand it, and you're going to do it, right? And I think that advisors feel traction there because they sort of tick the box that I said what to do. We have a tool that allows for a communication structure around, bringing the focus back to the plan, and then what's the thing that they're not doing that they should be doing. How far along are they in these various components of having enough equities in their portfolio to meet their needs, insurance, all of these sorts of things. Where are they in these scales, right? Because there is a scale from 0 to 100% there, and you move incrementally in some of these things. But I think that just because someone, as we were talking about, just because an advisor says something doesn't mean it's been understood and internalized, and it takes that training over time. And it takes stress testing different situations, because it may feel like a client understands and has internalized what has been communicated to them. But when it comes to a crisis, high stress moment, can they follow through?
Yeah.
And I think that what we find is, and often cases, no, they can't. And so that delegator client then wants to take back control. And so, when we looked at the study, we found that in a decline that, that I was mentioning, where investors, or rather advisors, wanted to buy stocks in a decline, and investors just kind of didn't know what to do. I think that also is just an indication that the advisors and the clients are just not quite meshed all the time. And what the advisor role has become more of is as almost a money life coach, because there are so many more decisions that need to be made around financial health than just, buying stocks.
Yeah.
That I think that, and I know that life coach is kind of an icky word to some people, but it seems to be more of the direction that things are going, because now, as what young people are doing now, the older people are going to be doing in 4 years, 5 years. So the advisory community has to catch up to that in some way or another. And their investment advice specifically and exclusively may not be the thing that they're looking for.
Yeah. Okay, I said that was the last question. It was a little bit of a lie, but it was the last hard question. These are just fun lightning round questions. Lightning round question number 1, what should my next guitar be?
Okay, so I can see the Les Paul Gold Top back there.
Got it.
The Telly Deluxe, if I'm not mistaken.
Oh, you know me.
And I think you've got a Gretsch Duojet.
I have a Gretsch and a Telecaster.
Okay, well, you're in the South, so you should get an electrical guitar company guitar. They are 100% made out of aircraft grade aluminum, so you don't have to adjust the action. And I just lost like half your listenership. But anyway, you can get them anodized blue, red, purple, whatever you want. But they're 100% aluminum, and they sound incredible, and they're handmade in Alabama, your home state.
Alabama. Okay. Yeah. Well, that sold me. If the first part didn't, the last part did. I'm sold. Second question, greatest metal band of all time.
You mentioned this is a family show. So I'm going to play it safe and say Meshuggah.
Okay. Have no idea who that is, but I'll be checking him out after this. Last question, top 3 guitar riffs or solos of all time. I will take a riff or a solo.
A again, the family show thing becomes a problem. So as Daniel knows, I'm a total metalhead punk rock guy. Okay, my hometown is Washington, D.C., though I lived in New York for 25 years now. So I'm actually going to go for a bass line.
Okay, that will allow it.
Waiting Room by Fugazi, bass line. Excellent riff.
Yeah.
I can't say that. Can I just leave it at one?
Say what you'd like, but people know if you check these out at your own peril.
Okay, South of Heaven by Slayer.
South of Heaven by Slayer.
Wolverine Blues by Entombed.
Okay, good. This is great though, because if you didn't come up with three, I was going to give you like stuff you would hate. I would be like, oh, he loves Stevie Ray Vaughan or something, and then
Moody Blues.
Your whole reputation would be ruined. Hey man, this was awesome. You provided a ton of value. If people want to read the report, if they want to find out about you or your company or the Institute, where can people go to follow you and read more about what you're up to?
So I am on LinkedIn, Eben Burr. You can go to tavescorp.com, which is spelled weirdly, but TOEWSCORP. BIIcoaching.com, the Behavioral Investing Institute. I'm mostly a voyeur on Twitter, but I'm there. Or you can just send me an email at eben@tavescorp.com.
Awesome.
Daniel, thank you so much for having me. It was a real pleasure.
This was a blast. Thank you so much.
Take care.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.